It's my pleasure this morning to introduce Dr. Donald Ratajczak. I know many about Donald, but I'm going to just say a few words about him. He is a leading forecaster and is currently a Regents Professor Emeritus of Economics at Georgia State University. We're all familiar with that phrase, when E.F. Hutton talks, people listen. Well, when Donald Ratajczak speaks, people listen. He really has some important things to say about where we're heading in this economy, and I think a very unique perspective of what manufacturing can do in terms of the base of the economy. So I'm looking forward to what you have to say today, and I know everybody is waiting for that, so I'll be brief in terms of the
please.
Today, I think you're going to hear firsthand his opinion on the state of manufacturing on a worldwide basis and what it's going to be happening for us here in Georgia. And as many of you know, Dr. Ratajczak was, for many years, the director of the Economic Forecasting Center at the Mac Robinson College of Business at Georgia State University. So he was always the guy speaking at Eggs and Issues and forecast. Well, he's currently Assurance America, also on the board of Ruby Tuesday, Brown Craft, and Citizens Trust Bank. He also, even though he's not a retired mode, he's continuing to produce a weekly and monthly economic publication for Morgan Keegan and a weekly economic publication, forecast for that group, and actually that's getting out into the media. So when Dr. Ratajczak speaks, many are really listening, as he is often quoted in print and the broadcast media, in the New York Times, Fortune Magazine, Wall Street Journal, Bloomberg, and CNBC. In fact, for the past 4 years, he's been ranked as the top 5 prominent economic forecasters in the USA Today survey. So please join me in listening to Dr. Ratajczak.
Thank you. All right, well, very much for having someone from Georgia State or Georgia Tech. Until recently, until recently we didn't have a football team, but we still don't. But anyway, we don't have competition in that regard with, we do have a little feedback, but we don't have competition in that regard with Georgia Tech, so that'll be fine. I don't know if I want to be labeled as E.F. Hutton talked, because E.F. Hutton doesn't exist anymore. And I'm hoping that maybe I'll be around a little while longer. But anyway, it's kind of interesting because some people made comments, hey, I'm hearing positive things about manufacturing, I'm hearing negative things about manufacturing. By the way, they're both true. And I'm going to spell out what's going on. Last year was the first year since 1997 that in the United States we actually increased manufacturing employment. Now, having said that, you have to understand that in employment, it's more or less like that old joke about, how to become a millionaire in the airline industry? Begin as a billionaire. And basically, so what happened is we took a big hit during the fiscal crisis, the financial crisis. The fiscal crisis coming up, but the financial crisis, we took a big hit in that, and we lost 2 million manufacturing jobs. Now, yeah, we're starting to rebuild a little bit again. There is some dynamism developing. As I said, last year, about 150,000 new manufacturing jobs in the United States. This year, every month until last month, we had growth in manufacturing jobs. Now, last month was a problem, some of which was seasonality. Basically, there no longer is a model changeover period in automobiles. They just roll in the models as they see fit during the year, some of them positioning it in September, which is the traditional new model. Some of them positioning it in January, and some of them positioning it when they feel that it's ready to be thrown out into the marketplace. So you don't have the basic close downs in July. Unfortunately, our statistical system still, because it does a backcast of what happens in the last 5 years, and so it's backcasting, and it says, wow, you know, July is you usually lay off people because you're redesigning and you're rebuilding your production facilities to handle the new models. And so since we don't have the same shutdowns as we had in previous Julys, of course, July, we said, hey, a lot of people are working in the auto assembly. Actually, fewer people were working, but more than traditionally work in July. So we said, big increase. And then August came, and we said, we didn't rehire those people that were off in July. What happened? Well, of course, we never put them off. So we didn't rehire them. So that was about half of the manufacturing numbers for August. But there's no question that August is slowing down. And if you look at the world statistics, you can see what's going on, because manufacturing and world trade are significantly correlated, as you would guess. A lot of goods are moving around the world at the present time. And 2 years ago, world trade grew more than 10%. And so obviously you would assume that we'd be able to have a pickup in manufacturing activity, not only here but around the world. Last year, world growth slowed down to about 4%. World trade growth slowed down to about 4%. This year, we're running at about 2%, and there is some fear that by the end of the year, we will be negative. Now, what's going on? All right, the first question is, what's China doing? It's always what's China doing, because China is now the big player. Now, it doesn't mean China is the most important economy. And by the way, China is not the top manufacturing producer in the world. The top manufacturing producer in the world is still the United States. We actually produce about 20% of all manufactured goods in the world. People are shocked when they find out. China produces about 12%. It is number 2, but it produces about 12%. Japan is fading at a little bit less than 10% now. Because Japan has had not only the lost decade, but it now appears it's going to be the lost generation. Japan has had serious trouble moving its economy forward. By the way, I should point out some of that strength at the latter part of last year. We actually were slowing down in other parts of the world before the latter part of last year, but masked it because Japan, after the tsunami, had dramatic repairs that needed to be done, and therefore tilted the world trade figures. Well, Japan is now off of the tsunami rebuild. There's still a lot of work to be done, but obviously the cresting of that activity is done. And in fact, Japan has now fallen back and may very well be in recession by the end of the year if they don't change policies, which, since they haven't changed it in a couple decades, I'm not sure they're going to do it now. But basically, it's one of those things. If I were, well, and I do from time to time, I talk to Japanese people and I say, why do you do this? Self-inflicted wounds. You continue to restrict the growth of the yen in international markets. Hey, the yen's growing fast enough, we got a lot of inflation. I said, yeah, you got inflation because you're importing goods. And when the world increases the price of goods, like when China was buying everything, of course, goods went up, and therefore Japan was forced to import inflation. Well, that's not what they should be looking at. By the way, the Europeans do the same thing. There's a lot of stupid decision-making around the world. I'll get to the United States in a little bit. Actually, the United States is the other way around. We set up a system that we have to make decisions and won't. So it's a whole different animal that we got here. But I'll get to that. But anyway, the Japanese, they keep sitting there. I thought they finally had it right, because last year what happened in Switzerland, basically when people are thinking, hey, the euro is dead, and what do I do, especially if I'm in Europe? What do I do if the euro is going to die? Well, I better find some other place to put my finances, right? And where do you do it? Well, in non-Euro European countries. Well, what happened is Switzerland got overwhelmed. The Swiss franc got way too expensive, and as a result, their manufacturing activity was tumbling down. They had lost dramatic competitiveness in the world economy. And they said, we can't survive this way. This is not what we need to do in Switzerland. And so what they did is they linked their currency to the euro, which, by the way, that's where it is now. So it's still a Swiss franc, but it's a Swiss franc euro junior because it's moving with the euro. Now, at a fixed, relatively high, Switzerland is a very expensive country. I go there once a year to talk to a bunch of Swiss advisors, and wow. I remember when I was doing 107, I would get 107 Swiss francs for $1. Now I need $107 for a Swiss franc, and that's 2 years later. I mean, that's a dramatic change in what's going on. And there's no change in the underlying inflation rates, so this is dramatic changes in the amount of cost of things coming in or out of Switzerland. Big problem. Well, I thought that the Japanese had learned from that, hey, if you're getting overwhelmed in your currency, that what you should do is, and by the way, how's the Swiss fixing their exchange rate? They pump in as many Swiss francs as the world to keep the relationship fixed. And they don't look and say, hey, is that too many Swiss francs out there? They don't say, oh, is that going to create inflation in Switzerland? Nah, they don't say that at all. They say, the world wants a lot of Swiss francs. Guess what? I'm going to give it to them. And the world doesn't want it anymore. I'll absorb them back. And basically just hold their currency. Japan, I thought, was going to do that. Early this year, if you've been watching the currency, the yen actually went up to 85 to the dollar. And I thought, they got it right, finally. And then the central bank said, oh, we're worried about inflation. And I'm sitting here, here's a country that hasn't seen a price increase in 2 decades. And they're worried about inflation. Actually, they've seen some in oil and a few of the imported goods. But basically, in fact, right now in Tokyo, the CPI has fallen year over year. And is now down about 0.4% from the previous year. They're back into a deflationary environment. They had a little spurt because tsunami rebuilding and all that and some temporary disruption of capacity, so all those occur, but now they're back into deflation. And the central bank, for some reason, is looking at how much yen is out there and not how much yen is out there relative to the demand for yen. Because again, people, remember, the Europeans are looking at other European currencies first. By the way, the Swiss solved their problem, at least temporarily. Now it's the Swedes worrying about the krona, which they're now losing their competitive position. And what are they going to do? The Norwegians, they figure they have enough oil, they don't have to worry about it for a while. So they're not, although boy, don't go to Oslo. I mean, it's a nice little town. But boy, if you really want to see what expensive is, you go to Norway. That's incredible. I can't believe that anything is produced outside of Norway. I mean, if anyone wants anything outside of Norway except for their oil, because they're so expensive in there. Anyway, I don't want to denigrate any individual country. And Norway is probably okay because it does have the oil. But basically, there are problems around the world that you sit and you wonder why these people are following these policies. Why are they doing it? Why does Japan want to be deflationary? By the way, their manufacturing industry is very upset. And I don't know if you've noticed, but auto production is coming back to the United States. Probably the amount of automobiles produced in Japan has peaked for this year. That doesn't mean Toyota's production has peaked. I mean, they just build another facility onto their Georgetown facility in Kentucky and look at everyone else and the development of the automobile industry in the South. How many assembly plants have we opened up in the last 10 years? Hyundai, Kia, Mercedes, of course, started the whole trend. BMW, as you throw out the names, you probably know where the assembly plants are in South Carolina and Mississippi, Alabama, and now the new plant they're opening up in Chattanooga. So you have a lot of automobile activity developing in the South right now. And part of that is, of course, where is your market? Biggest automobile market in the world is still the United States. That could change sometime in the future. The big change would come as more infrastructure, meaning highways in this case, is added in China, because there's a lot of Chinese and some of them have money. Now, not all of them. Apparently, China has a communist country. What economists, we use something called the Gini coefficient to look at the degree of economic imbalance in the country. China, of all of the industrializing countries, and this includes Brazil, which also has a similar problem, they have the highest Gini coefficient. They're a communist country, supposedly. They have more billionaires than the United States does right now. Okay? And are growing it much faster than we are. It's not that, hey, the country is just blossoming and everything's growing. There are parts of that country that are blossoming, but not all of it by a long shot. And yet, you are finding that the ones that win are winning big in China. So you get extreme measures of income inequality. As I say, it's a similar problem in South America. Actually, in all of Latin America, it's a similar problem that the wealthy tend to get more wealthy. As you know, the richest man in the world right now is a guy in Mexico. Now, it's not the guy in Omaha. He took a couple of bad investments. His 30-year return has fallen to about 17% annually. Used to be at 18.5, but too bad. Anyway, and it's not the Facebook guy either. He was wealthy for a week. Actually, he's done quite well. He was in the mega billions, and now he's in the only multi-billions. So anyway, that's what's going on. All right, let me. This is all in an introduction. I got to warm myself up, you see, to get what's going on here, because tomorrow is a very important day for economists. You might say, "What's happening tomorrow? Is there some new economic theories coming out?" I haven't seen a lot of new economic theory in 30 years. I hate to say that because there's a heck of a lot of papers regurgitating old stuff. Anyway, my economist colleagues would kill me on that, although they know it's true. But nevertheless, no, tomorrow is big because two major decisions will be made. And two central banks. Well, actually, no, one central bank and one Supreme Court. But tomorrow is huge. All right. Tomorrow, after a two-day session, the Federal Reserve will announce whether or not it will change its policy. Okay? Now, what will the Federal Reserve do? Well, the big feeling is, and I don't concur with the timing, but the feeling is that, hey, not enough has been done to stimulate the U.S. economy. The big problem, obviously, is in Washington, outside of Constitution Avenue, which is where the Federal Reserve is. But the Federal Reserve now is, because the other guys aren't acting, Federal Reserve is being asked to act. And it's likely that they will act further. And will they act tomorrow? I think it's highly likely that they will act further. I think it's not likely they'll act tomorrow, but I hate to do that because you'll know, do I have any validity in my forecasting? I can be proved wrong in one day. Forecasters usually shouldn't make a forecast that they're not able to get out of town before it happens. Anyway, we'll see. But, all right, what will the Fed do? they have, you know, people say, hey, what could they do? We're at zero lower base, which means that the federal funds rate is trading between 0 and 0.25%. So they really have about 3 things they can do. Number one, they can see zero lower base for an extended period of time. Now, there is a lot of confusion about this. The Federal Reserve right now is guaranteeing zero lower base through 2013. Their forecasts, which they also publish quarterly, their forecasts indicate that they believe that interest rates will be unusually low. By the way, the median forecast is not zero lower base for 2014. The median forecast, and this is out of 18 guys, 18 people, there are a few women in there, but women are guys too, in my language. But anyway, 18 people, these are the people making those decisions. These are the board and the presidents of the Federal Reserve. That's who, when they say the Federal Reserve forecast, that's who's making the forecast. Therefore, they have the power to make their forecasts right. All right? So, anyway, what are they forecasting? They're forecasting low interest rates for 2014, but not zero lower base. The median still is 0.75%. So the presumption would be that a majority, or at least half of these people, think that it is likely that we'll get off of zero lower base sometime in 2014. However, that's the forecast before the latest employment report came out. So, and the latest employment report was not a good report. There's no, even though I already explained away what happened in the automobile industry, and you can look at those seasonals. And by the way, some of that also because we used to, in the South, we used to shut down plants for 3 to 4 weeks in July, basically because it got very difficult for people to work. There is a little bit of that still in there. That you are finding that, hey, we expect plants to be shut down in July, especially in the South. That did not happen. Of course, we have air conditioning all over the place now, so it doesn't happen anymore. Or maybe you don't have as much air conditioning as you should, but, you know, and you might, when it gets 106, you might decide that maybe the workers can go home because you don't want them to keel over. So basically, some of that does still happen, but that's the idea. And a lot less of that happens. So there is some seasonal shift from July to August. Let's be honest about it. That part is almost all done. So you take a look at the figures, and those figures weren't very good. And not just in manufacturing. And the manufacturing weakness was widespread. Only 32% of manufacturing industries reported hiring in August. 32%. That's a recessionary level of hiring. That's not good. Okay? Bad problem. Some of it, again, the seasonals may have screwed it up a little bit and made the figures a bit lower, but that still isn't a good number even after you filter out all these problems. All right, so Fed is going to do something, and it's probably the next forecast is not going to show a median at 0.75. It's going to be somewhat lower. Now, so we get back to what can the Fed do, the 3 things. Number one, they can extend the guarantee. Remember, the zero lower base is only publicly guaranteed through 2013. Now, the markets are assuming that zero lower base will persist into the first quarter of 2015. Now, actually, the Fed could guarantee that and say we are not going to change from zero lower base until the second half of 2015. And that would, in fact, as a result of that, you had the short term, it's not going to make a lot of difference until we get to that period of time. But the long term, it makes a difference. Because long-term interest rates are sitting there and saying, when are they going to come off of zero lower base? I mean, right now, my 10-year bond is competing with 0 returns for the first 2 years. If they tell me I got to compete with 0 returns for the first 3 years, that means I got to lower my rates on the long-term bonds. So that's why you would make the guarantee, to lower the long-term rates. And it's quite possible that they may guarantee. But remember, the long-term rates are already feeling out what the market believes. So if the Federal Reserve says, hey, I'll guarantee through 2014, that's a non-event, even though that's a statement of a new, easier policy. Because the market is expecting them to go to the first quarter of 2015. And therefore, the long-term rate already has incorporated that into it. All right, so that's number one they could do. They can extend that guarantee. I think that's a likely outcome. They may even do that tomorrow. Number two, they could increase the size of banks. This is what's called quantitative easing. Prior to the financial collapse, I keep saying fiscal, but the financial collapse, prior to the financial collapse, the Federal Reserve held $800 billion, almost all in short-term Treasury notes. Some of them very short, like less than 30 days. So there was very little interest rate risk being held by the Federal Reserve. And they would have about $800 billion. The crisis came, banks weren't lending. Federal Reserve thought that because banks weren't lending, to be a direct provider of funds. How do you do that? You buy financial instruments and put out the Federal Reserve credits, which are notes. You know, those things like that. Those are Federal Reserve notes. So basically that's what they did. They extended it twice. They announced expansions and built it up to $2.8 trillion. So we went from $800 billion to $2.8 trillion. Basically because the banks weren't lending. Now, actually, that particular problem is slowly being resolved. Banks will lend now. If you sit there and say, oh, I don't know. And I had a discussion this morning with some of the people at our table. And basically, if you are an enterprise with a predictable receivables base, you will find banks not only willing to lend to you, they will want to lend to you. They are looking for borrowers. They would like to build up their loan portfolio. At the present time, the banks want to lend, at least if you have predictable assets. That's what they're looking for, predictable assets. They're not yet willing to concede that real estate is going to have predictable value. And in fact, the appraisers are still, because appraisers are backward looking, and the appraisers on real estate are still marking down real estate prices, even though we know as economists that in the last quarter, housing prices have started to rise, even in Atlanta, which, by the way, is the worst performer of all the metropolitan areas. Atlanta lost 12% of its housing value in Atlanta metropolitan area, lost 12% of its housing value in the last year. The United States right now is positive over the last year, about 0.7%. So it doesn't sound like a big number, but remember, we went into the year at -3.5. So now we're positive 0.7. Just think what that means, what we did in the last quarter. We were running nicely positive in the last quarter. And it looks like that trend is continuing. And in fact, I use my neighborhood as a measure. It's not too far away from here, and we do have a lot of houses for sale. But we have one of them that is announced it's sold, which I guess means that it's all done and they're ready to, and they already closed, but the person hasn't moved in yet and therefore didn't remove the realtor sign, so he has this nice sold thing to tell people, hey, I really did it. Anyway, and 4 of them are under contract. Now they can break, and we now know that something like 50 to 60% of all contracts break because of the appraisal. That the appraisal comes in and says, no, you can't lend what you just agreed to buy that house for. We're not lending you that because we don't think the house has that value. By the way, we may think, but we have this association that we go to in Iowa or Nebraska or Idaho, and on their computers they say prices are still falling. By the way, if you don't know that's true, I had a friend last month who changed his banker because his banker of 20 years told him, we can't make that loan for you because this is I mean, we could, but you got to put more equity up. He was already putting 25% up, by the way, to sell his house, or to buy a house, 25%. Why wasn't 25% enough? This is a declining price area. Therefore, the computer models are forecasting the prices are going to go down further, and they simply don't want to make a loan that is going to be qualified in the near term. So he found another banker who probably went to the Idaho guy instead of the Iowa guy, and maybe he was not as sharp on figuring out what previous sales were, or whatever the case was, or maybe he was clever and he started to look forward, which is unusual, and he finally said, yeah, you don't have to put any more down. We'll take your loan. But yeah, real estate's still tough because bankers aren't sure of the asset value that they're putting on. But if you have predictable receivables, they'll lend you every day, which is telling you that there isn't a loan problem if you have a healthy business at the present time. Okay? All right, enough of that. So anyway, I only gave you one, so I gave you the second thing they could do, which is expand their portfolio again. Go from 2.8 trillion to 3.5 or 4 or some really big number. The only issue with that is, remember what I said? At 800 billion, they had notes. There was very little interest rate risk. The Federal Reserve could hardly lose money. When you go to 2, they're already at 2.8. They only have 300 billion in short-term bills, which, by the way, they're going to liquidate because they're doing something called Operation Twist, selling the shorts and buying the longs, and therefore the 300 billion will be gone by the end of this year. They will have no short-term interest rates, and therefore they will be subject to losses. What does the Federal Reserve, what do you think is the next problem the Federal Reserve is probably going to face? Do you think absence of liquidity? That was the legitimate problem when they expanded it. Probably the next problem is going to be that they put too much liquidity into the system and we're starting to get inflation. What would that mean? They would have to sell out of their holdings. When would they be selling if you had increased inflation? They'd be selling as interest rates are rising. They have interest rate risk on almost all their portfolio. They'd be selling. Would this change the behavior of the Federal Reserve? Would they be more reluctant to fight inflation in that environment? Now, the Federal Reserve says, no, it's not a problem. We don't worry about profit and loss. But guess what? Right now, the Federal Reserve is returning $70 billion a year to the Treasury. They are a profit center because as you expanded, wow, they bought bonds, got higher interest rates, and what did they give? They gave out paper. Okay? It's a good game. The Federal Reserve is the only one who can play it, but it's a good game. All right? Well, what they'd have to do is they'd have to record losses and tell the Treasury, give us back some of that money. And the world is worried, or the United States is worried about deficits. That $70 billion right now is an offset to the deficit. And then they would go from a positive 70 to a negative 70. Do you think the Congress is going to be happy about this? You think they're going to not interfere with Federal Reserve operations? Federal Reserve thinks it will. They're wrong. But they don't know it yet. So this is a dangerous game they're playing if they expand it further. But they may. In fact, the markets are assuming they will. The latest based upon swaps that are being made is that will be a quantitative. So the Federal Reserve will be buying more bonds. It lowers interest rates is not clear because remember, this increases interest rate risk. You then have to figure out, do I really want to be selling my bonds to the Federal Reserve? What do I want to do here? Do I want to hold long? Do I want to hold short? Where do I want to go? And basically, at some point, I think people will say, this has the potential for raising inflation later on. And as a result, maybe it won't lower rates at all. It will add to liquidity because it'll be another source of funding. By the way, I said there were the third thing is right now the Federal Reserve is paying 25 basis points, a quarter percentage point, to banks for deposits that the banks are putting at the Federal Reserve. They could actually change that deposit rate. They increase it, what will happen is banks will put more money into the Federal Reserve, thereby lowering their lending activity. If they drop it, the banks will take the money out of the Federal Reserve and try to find an alternative way to raise resources, therefore expanding their lending activity. So, in point of fact, that's the third instrument they can do. So that's what the Fed can do. All right, I spent too much time on that. But all right. In Germany, well, we have the European Stabilization Mechanism, a 500 billion euro facility, which is going to be the facility that Draghi would probably at least have assessed the countries that wanted him to buy their bonds. Although Draghi has made it quite clear, Draghi is the head of the European Central Bank, he's made it quite clear that he will take funds from the European Central Bank and buy these securities if he has to for the good of the euro. And by the way, that's what he reaffirmed last week. He said it doesn't depend upon the economic stabilization mechanism, but obviously the economic stabilization mechanism is a very important part of the stabilization of the sovereign debt problem in Europe. Okay? So what's the Germans going to do? Well, the economic stabilization mechanism is being supported. Where did they get the 500 billion euros? Everybody put some money in. Okay? Yeah, even Italy put some money in. They're going to take it more than that back, but they'll put some money in too. So they all do it. But, okay, so what's going on? A case has been brought before the European High Court arguing that you cannot use German bonds for non-German purposes. Okay? And as people have argued, this is a non-German purpose. Of course, Draghi has argued that it is a German purpose. And by the way, if we all know about in Germany, why is Germany willing to bail out all these countries? Why are they trying to save the euro? Well, think about the alternative. Okay? What's the alternative? The alternative is they go back to the mark. What's the problem with going back to the mark? The problem is, right now, the euro is a blended currency. They get some of Italy's problems and some of Spain's problems, as well as some of the strength of Germany. Guess what that means about the currency value that is provided for German exporters? It lowers their costs. Going back to the mark would be devastating to the German export market. And by the way, 30% of German GDP is exports. Okay? Much larger. We're 10 to 15 in the United States. Much larger as a percentage of their economy than we are. So it's a significant factor for them. That's why they want the euro. So the court could argue that this is a German purpose. I would argue it's a German purpose, but, you know, lawyers don't always think like economists. So who knows how he's going to rule. And if he rules that you can't use it, then, of course, you can't fund the European Stabilization Mechanism, and that means you are left only with Draghi, and they are criticizing him for going past his mandate. And if they shut that down, then the euro collapses. And if the euro collapses, as I say, ultimately it's not good for Germany, but initially it's not good for all of Europe and may not be good for us. So aside from the fact that Germany is a customer, I mean, Europe's a customer, so why isn't it good for us? Because there are a lot of euro contracts. If the euro goes down, how do you settle those contracts? Well, you'd have to settle them with the alternative currencies. Now, the Germans would be able to do it easily. The Italians might, with a significant effort. The Greeks, forget. We're not even talking to Greece. The Spaniards couldn't. Spanish banks would collapse. anybody lending to Spanish banks would be in trouble, and that includes at least the big 4 American banks. So we're back into a financial crisis. So that's why we worry about it. I mean, not just that a customer goes bad, but that we get contagion from it. And it could be a serious problem. So those are very important announcements. I'm going to go very quickly. What do I think is happening? I already mentioned the dramatic slowdown in world trade. What's going on here? Well, number one, China, after using a stimulus program to, in fact, excite activity in China, coming off of the financial crisis, they actually overexcited. They had a yuan stimulus program, about $525 billion of stimulus, mostly roads, port dredgings, improving their communications facilities, very much infrastructure-based stuff. You know, so you can move information and you can move goods. And infrastructure investment is very important, especially for developing countries. A huge debate in the development literature in my profession, arguing what's more important. Is it infrastructure or education? The evidence shows that at a certain stage of development, by the way, the earlier stages of development, it's definitely infrastructure. Don't worry about educating. You're able to deliver whatever they produce. If you can't deliver what they produce, who cares about educating them? India had educated people for 2 generations who never were able to fully use education. What changed India? The internet. Because for the first time, that body of intelligence was able to reach out to the world community. Prior to that, they couldn't. They couldn't get their return on education. Okay? And that, quote, the Indian miracle, is an internet offset. And by the way, we're now finding out that that group now is getting fully employed. Yes, it has helped India, but where's the next group? Where is it coming from? And it looks like India is, it's still growing. It's going to grow almost 6% this year. But I'm going to have some debates about India in a little bit. But nevertheless, that was one example that education before infrastructure is probably not using your money wisely. And in fact, in Latin America, you'll find that there was very strong belief in infrastructure development first, before education. Now, obviously, you need them in tandem, but you know, with limited resources, where do you put your heaviest effort? I was trained as an American economic historian, and I could tell you that, you know what really created the middle class in the United States? The method by which we handled our ports during the colonial age. Our port transportation mechanism and storage mechanism, we set up the idea that we didn't have to depend upon the boats arriving. We would have the storage facilities in place, and when the boats arrived, we'd move them in, move them out, and therefore use storage as the dominant activity rather than the movement of the boats. So we still needed the movement of the boats, but we knew they were irregular. We created regularity. And as a result, you got about 0.3% per capita growth per year as the ports improved their facilities during the colonial period. By the way, that's true in my history classes. Actually, I didn't learn my history. I taught history. You always learn it when you teach. People who teach know that. That's where you learn. But anyway, that's what happened. And it was infrastructure development, although these were very educated people, as a rule, during that period of time. Or a lot of them were, anyway. That's and infrastructure development, that's what China did. It worked beautifully. Actually, it worked too well. China came out of the financial crisis, and in 2010, it was growing 11.3%. Here is the second economy in the world growing 11%. It's gobbling up all the materials. It was taking down 60% of all the copper production in the world. It was taking down 40% of all the iron and steel production in the world. Guess what was happening? We had an explosion in commodity prices. Remember that 2 years ago? That was China. And that was the result of their infrastructure development coming off. Which, by the way, negates the argument, oh, can government ever do anything useful? And the answer is if they build assets with their stimulus, they can do useful things. It's when they take money out of one person's pocket and put it into another that doesn't work very well. By the way, you want to know what country did that? So, anyway. So it's not government spending, it's how they spend. But I don't think I'm going to be able to pass that argument on to too many people right now because everyone looks at, oh, the deficit's terrible. And I look at, hey, the bridges are falling down. What are we going to do about it? Oh, the deficit's terrible. Well, what happens after the bridge falls down? We're not managing our assets. Anyway, that's a long story. All right, enough of that. So, the European Union is critical, and it looks like it could be in difficulty. Tomorrow's ruling is going to be very important. Isn't the death knell? Remember, Draghi could offset even the lack of finance of the European stabilization mechanism. 500 billion euros of expansion in the European Central Bank? That would be a serious erosion of his mandate. And he might get away with it. Wow, I don't know if people know who was there before Draghi. Trichet. Boy, if Trichet was still there, we would definitely have a major recession in Europe and probably a collapse of the euro. Because we don't touch that mandate. It's inviolable. And of course, Draghi, hey, in central bank, what's our first rule? Stabilize the euro. That's my first rule. So I ought to be doing whatever is necessary to stabilize the euro. So anyway, enough of that. All right, let's get down then to what's going on. So the Chinese overstimulated, and then they got nervous because as a result of the overstimulus, remember all these billionaires and all, property values got absurd. They finally got their real estate bubble. It was just, Hong Kong got so expensive that no one wanted to be there anymore. They decided it's time to shut things down. And here's the problem. They did try to shut things down through monetary restraint. They kept increasing reserve requirements at the banks in China. Point where the leveraging of the Chinese banks could only be 5-to-1. If you want to know the leveraging, according to regulations, we can be 12-to-1 in the United States. And by the way, they ought to be 12-to-1 in Europe, but they're about 15 to 16-to-1. European banks are... but anyway, they got it down to 5-to-1, which kind of says you can't make money in banking. All right. Eventually, that slowed down the economy. The problem is they didn't figure out that their exports were one of their growth drivers. That's their manufacturing activity, exporting, was one of their growth drivers. Okay? Exports are financed offshore. So raising the reserve requirements of local banks squeezed the domestic economy, exactly the opposite of what they wanted in China. It took them a while to figure this out, but now obviously the growth rates are tumbling. China was assuming, and this year's forecast, by the way, China assumed that their trade would grow 10%. You know what the trade is doing? 2.7. Their exports grew 2.5. By the way, their imports are negative right now because, remember, they squeezed down their domestic economy. Their industrial production is growing about 9%, and that's with their way of measuring it. Everyone else's way of measuring it would say it's more like 5%. This is, for a country like China, this is drastic slowing. There are manufacturing facilities in northern China that are totally empty at the present time. There's raw materials stacking up in the storage facilities in Shanghai. Actually, I just read the article in the Wall Street Journal this morning about copper. They not only have the the sheltered storage facilities filled, but they have it outdoors. And one person walked around and said, the inventory is now cracking, which means that the weight of the inventory is so heavy it's cracking the earth. So they're not using the raw materials. So China has slowed down dramatically. We're not talking about 1 or 2 percentage points slowdown. We're talking about 4 to 5 percentage points slowdown going on. Probably the third quarter, we're going to be at 7 to 7.1% year-over-year growth in China. Remember, it was 11.3 2 years ago. Dramatic slowdown taking place. And by the way, this has affected the rest of the emerging markets. The emerging markets were finding, hey, when China was overheating, they were doing well. And in fact, China is now getting fairly expensive. Labor costs have gone up. The yuan did increase in value. So you put the two together, and production costs in China, I'm on the board of a company that does soft goods, and we're taking stuff out of China 9% more expensive than we did maybe 15 months ago. 9% higher costs. So what are we doing? We're looking for alternative places. And by the way, we were going to go to Thailand, and then the river flooded, and that slowed down things into Thailand. Indonesia now is apparently the preferred place for where do you go after China if you're looking for low costs. But we'll see how all that develops. And Indonesia is holding its growth rates. It's now growing it has been growing 7%, still holding at about 7%. But everything else, Korea has slowed down to 4%. Singapore was close to recession. It looks like it's going to miss that, but came close. Taiwan has slowed down. You have, and of course, Japan, as I said, could be in recession by the end of this year. So significant slowing going on, and a lot of it, some of it tsunami, but a lot of it China taking place. Okay. So that's what's going on at the present time. And Europe, which is now in recession. Euroland actually had a negative growth rate in the quarter. Now, not all the European countries, to be sure. I mean, you take a look at Italy, and it fell at almost 4%. You take a look at Spain, and it fell at almost 6%. These are annual rates. You take a look at Germany, and it grew 1%. The Germans, remember, are benefiting from the low euro. And the euro was tumbling until Draghi made his announcement. Okay? Euro actually got down to about 123. Now it's about 127, so there has been some improvement in that. But the Germans have been able to hold off largely because they've been able to export out of the Eurozone. They're doing okay in the Eurozone too, but they're able to export out of the Eurozone as a result of the low euro value. All right, so but if you put it all together, France is flat. So you add all these economies together, and it comes out to a negative 1% at annual rates in the second quarter. Probably be negative, probably more than that in the third quarter. And the fourth quarter may be about the same. So it does look like recession there. United Kingdom, not quite as clear. They were definitely in recession mode in the second quarter and early in the third quarter. The Olympics helped them. Certainly changed the mood. And by the way, who knows? Murray won. Wow. First Brit. By the way, he's a Scotsman. But today he's a Brit because he won. The first Brit since 1936 to win a tennis championship. We're not counting the guy who shared the championship at Wimbledon. It was only half a team. That was a Brit there. But anyway, by the way, he was the first one really over that period. But nevertheless, enough of that. But yeah, the mood has changed, and it does appear that the British now may have a positive quarter, but it's not going to be strong. So Europe is a significant drag. China is blaming Europe for all of its slowdown, not realizing that the extensiveness of its policies against its banks was the primary reason why China slowed down. And they have to reverse that in order to get things going. Now, they are in the process of reversing it, but not understanding how much it has created a problem, they're not as drastic in shifting it back. So you're still finding very heavy leveraging, very modest leveraging in the Chinese banks. They're slowly coming back, but it's a slow process. And the fact that imports actually fell last month is very indicative of the fact that the domestic economy in China is not doing very well at all. And that was the hope, that the domestic economy would grow in double digits and bring up China, and it's not happening at this point in time. All right, so anyway, what does that mean? Well, it means that the world depends upon the United States right now. That's what it means. Last year, we had 4.3% world growth. This year, we're going to do 3.4. We're going to end the year, depending upon the United States, at about 3% growth. Now, if you say, well, 3% growth, that's decent. No. 3% growth, because of the population growth around the world, is really minimal. Okay? Now, it's not a fundamentally recession, but it's close to a recession. So, and that's what's going on. So let's now get back to the U.S. What's going on here? Well, we have our three big problems. I'll go real quickly. We got the fiscal cliff. What is that? The fiscal cliff is, well, that's the three problems. But the fiscal cliff is basically, number one, on December 31st, the Bush tax codes expire. And that means that if the Congress refuses to act, that we go to the Clinton tax code that existed in 2001. That's 28% on capital gains. It's a 39.6% marginal tax rate. There is no qualified dividend offset, so dividends go back up to being treated as ordinary income. So you have a lot of changes. The estate tax goes to $1 million. All of these things occur if Congress fails to act. Okay, let me give you the other parts of if Congress fails to act. Number two, tax holiday, the 2 percentage point reduction in payroll taxes, that's about $110 billion of infusion into the household sector. And more, by the way, the lower income groups in the household sector. That expires. The extended unemployment program, whether it's good or ill, that expires. That's another $40 to $45 billion. Okay? And then, because the Congress couldn't come up with a long-term deficit reduction program, we have automatic sequestering of expenditures. $1.2 trillion over the next decade, or approximately $110 billion beginning in January 1st. These all occur unless Congress acts. If you add up the totality, by the way, half of that, the sequestering is all undiscretionary, so it has nothing to do with what is creating our deficit problem. Our deficit problem is in our entitlement programs. And by the way, it's in, first of all, it's in a couple of areas of the entitlement programs. In the Social Security, it's in disability. Disability is growing 3 times as fast as the total Social Security payouts. And it is kind of interesting. You watch people and they're on unemployment and they get the unemployment for 99 weeks. Now, in order to get unemployment, you have to declare that you are ready and able to work. And then the 100th week, they apply for disability, which says you can't work. Okay? You think this doesn't happen? 1/3 of all new disability cases are coming off the unemployment rolls. Okay? That's fraud. Somebody's fraudulent somewhere in that position. Okay? So, obviously, this is a serious problem. This is draining the Social Security system. Would tightening the disability program solve the Social Security system? No. We got to do more. But we could solve that. That's a solvable problem. We would probably have to extend over a long period of time, extend the age Certainly get rid of the 62, although there's a big debate as to, hey, that may save us money rather than cost us money. I still think it costs us money. But never use that, move from 67 to 69 over another long period of time. Probably take the cap, and I know this is where people scream, take the cap off wages on Social Security. Those things would solve the Social Security problem, will make it solvent for the next 75 years, assuming that you get some control over the disability. Okay? Now, on the medical side, I don't know if you've seen the numbers, but we put out about, at an annual rate, of about $550 billion of Medicare. We put out over $400 billion of Medicaid. Medicaid is growing 2.5 times as fast as Medicare, and in 10 years will be larger than Medicare. We obviously have to control Medicaid. We made promises on Medicare. We did not, well, we made short-term promises on Medicaid, but we didn't make long-term promises on Medicaid. Now, a portion of Medicaid is clearly for young, sick people. I mean, really young people. And we really ought to address that as to what we do with that. A significant amount of Medicaid is people who have exhausted their funds and go into nursing homes. Okay? Now, you might argue, well, what should we do with the old people? And that is a relevant issue as to what we do with them. But basically, we do have to recognize that there are restraints. That you can't have open-ended entitlement programs. You simply can't. That's what's blowing up the budgets. Open-ended. Hey, we promise you this, so if you show up and you meet the criteria, you get paid. Well, what happens if we're not producing enough? What happens if the economy's not growing fast enough? Still paying. By the way, if the economy slows down, your problems actually accentuate, as I already indicated, on disability and other things. So what happens on those conditions? What if you don't have the money? What do you do? I mean, these are very tough decisions. That's what is required by people to figure these things out. But that's what's going on. All right. Anyway, Medicare, we've had some good, believe it or not, we had some good luck in the last 2 years. Well, luck, we could argue whatever it is, but medical inflation has only grown about 1% faster than underlying inflation. Historically, medical inflation grows 3 percentage points faster than underlying inflation. There are several. There is a study I just read that indicates that up to $750 billion of our total expenditures in medicine are as a result of a whole bunch of administrative up to fraudulent. Fraud is only about 10% of the $750 billion. But there is fraud, too. In that. Defensive medicine is about $200 billion. Bad administration, and bad administration goes through the lot, which is anywhere from requiring too many forms and all this kind of stuff and repeating the forms all the time, which is very expensive. Apparently a doctor's, my doctor who has since retired because he found it was better to actually manage rental properties in Paris than engage in medicine in the United States. And I still have a dubious, if it was some other place but Paris, I would have said, yeah, it works. But I don't know. I'm not talking, Paris is a wonderful place. I'm just talking about the business climate in Paris. But anyway, when he started his practice, he had 5 doctors and 3. When he retired, he had 5 administrative assistants. Okay? Get an idea that maybe there's something wrong here? It's paperwork, trying to deal with how you get paid, who pays you, how much, how you change your pricing. And by the way, our doctors don't know anything about business. In medicine, even though most of our doctors are small business people, they get 4 hours of business training in their 3 years of medicine. So they know how to cure you, but they don't know how to. And some of them grossly, and some of them undercharge. Those that undercharge find out other things to do, or they go on a salary position. Okay? So, anyway, medicine has serious problems, and we're going to have to deal with it and try and figure out how we can bring that number closer. If it's growing faster than inflation, what does that mean? It means that medicine is growing faster than our normal capacities to pay for it. Because wages are probably growing in line with inflation. Maybe a little bit more with productivity gains, but that's what you're expecting. And therefore, your capacity to pay for this is lagging behind the costs, especially if it's 3 percentage points faster. Because our productivity doesn't average 3 percentage points, even when our inflation was in the case in the last decade. But even if it is that, not charging that. So that's the fiscal cliff. It's a total of about $700 billion. Remember, what does it require? Congress must make a decision. By the way, they have to make a decision before the end of this year, which means, since they're not going to make a decision before the end of the election, that people who have been repudiated by the electorate will need to make a decision. Yes, whatever you think about Obama and whatever he happens to happen, he is going to be president when this decision is made. Okay? That's the reality. It doesn't matter how you vote. They set up the system. We can blame anybody you want. Romney is blaming the White House, and other people are blaming the Tea Party. There's a lot of blame. They're probably all justified. But the point is, they have to make decisions. And they have to make decisions in not a very friendly environment. Okay, so what's all this got to do? People are afraid. They don't know what's going on. They're uncertain. So what do we see? Our last consumer confidence index, while people said current conditions, well, it's kind of stable, it's not good, but yeah, this month is about the same as last month. But then you ask them, what do you think about the future? They say, oh my God, are you kidding? Expectations about the future plunged 10% in the last survey. All right. If you feel that much less certain about the future, what are you doing about ordering new equipment? What are you doing about expanding your business? What are you doing about hiring new people? What are you doing about taking on more risk? Well, we can see the results. Orders are coming down. And that is excluding whatever happens in the rest of the world. Remember, China is weakening, Europe's in recession, and here we are creating our artificial uncertainty because our politicians won't make a decision. Okay? Now, I'm not a political scientist, so I'm not going to criticize one way or the other about what the politicians are doing. But I'm an economist, and I have to say, what's the results of that? And the results of that is the absence of decision-making. And the absence of decision-making is not good for business. Okay? So that's where we are. Now, there's some good news. Someone's going to make a decision. Even if they don't make a decision, then we'll go into recession the first half of the year and then come out of it. Yes, it will. If we hit the fiscal cliff, we'll go into recession. Okay? Which is why people won't make those risk decisions. Okay? Now, to be perfectly honest, every forecaster, including me, is not assuming that. Because we're saying that even our politicians will realize that when you get to the precipice, you stop. Okay? And we're hoping that that's true. So, I mean, it's the same forecast we have for Europe, which is basically they muddle through. They don't solve the problems. They keep kicking the can down the road, hoping that if they kick it down long enough, some solutions will arrive. By the way, in Europe, that might happen. In the United States, I don't know. But that's the likely outcome. That will kick it down the road, that the lame duck Congress will, in fact, just pass everything on. Say, oh, 6 more months, and let's go through it again. and then go home. That's the most likely outcome. But nevertheless, if you're a business person, do you assume muddling through? And by the way, 6 months further, does that really solve anything? So you still don't make your decisions. And that's where we are. My forecast, by the way, is that after about 1.5% growth in the third quarter, we'll probably do about 2% growth in the fourth quarter. The housing is turning, and that's a positive. And it does look like state governments are now back in balance with their revenues, their reduced revenues. Local governments are still struggling, but state governments look like they're more or less in balance and don't have to do the massive they've been doing for the last couple of years. And that's a positive. Again, the world economy is sluggish. There isn't a lot of growth. If there's no trade growth, don't look for a lot of manufacturing growth. Okay? So we don't expect much there. There is one saving grace, and that is, again, automobiles. If you take a look at what's been happening around the world, now I'll get into manufacturing part, and then I'm supposed to give you some time for questions and all. Anyway, the manufacturing part. If you take a look, the developing countries are growing obviously faster than the industrialized countries in all segments of manufacturing except transportation equipment. Major exception, by the way. And I said transportation equipment because I'm including both automobiles and air activity. Okay, so that's where the industrialized countries are showing dramatic growth. Now, can that growth persist? Well, if you get the credits, the answer is yes. If there is facilities, even households that are struggling and aren't sure about the future, they will replace vehicles that are not performing the way they want them to perform if they can get the credits. Okay. Now, 4 years ago, I don't know if you remember, but if you looked at the ads that we had 4 years ago, leasing disappeared. There wasn't any leasing program. Why not? Because used car prices were falling 10% a year. Well, here it was, you did a lease, you thought you knew what used car prices were going to do, you got that car back and you automatically lost a few $1,000s on the loan. Well, this discouraged you from making more loans. So, in point of fact, we didn't have the leasing. Automobile sales fell below 10 million units. Okay? By the way, one of the programs, deeply criticized by most people, actually proved to be beneficial. The clunker bill. Now, not because we removed clunkers, we destroyed them. That's why. And you sit there and say, what's the difference? The difference is, by destroying them, they weren't a resale to someone else. What did that do to the used car inventory? It reduced the used car inventory even as we were selling cars. Whereas mostly when we sell cars, we increase the used car inventory. Like now, what do you think is happening to used car prices now? You got the class here? What do you think? Used car prices have stabilized and are about to fall. Okay? What do you think that's going to do to leasing? It is going to tighten it up a little bit. But right now, not too bad. Because the last year, we've had about a 3% increase in used car prices coming on top of a 10% increase in the previous year. Okay? So leasing's still pretty strong, but the lenders are getting a little antsy. They probably don't know yet that that lease they just wrote is going to cost them about $1,000. But when they start getting those leases back, they'll know it. Okay? And that's their big concern. Okay? Right now, we have the need to replace. We got 230 million vehicles. You got to do refurbishing, repair, and remodeling. That's what's driving this economy. Even the household sector is doing repair, refurbishing, and remodeling. They can't sell their houses, so what are they doing? They're remodeling them. So all of these things are happening. Okay? That's the driver we have in the economy right now. The driver that's missing is capacity expansion. People aren't doing that. That's taking on more risk. Heck, why should I make that decision when it could be nullified by the failure of my elected officials to make decisions? Okay, enough of that. But anyway, the motor vehicles is where the industrialized countries, and by the way, when I say that, if you take a look at manufacturing, remember I painted a slightly bad picture about manufacturing. There is one region of the world where manufacturing as manufacturing output is actually performing better than it did a year ago. Fortunately, we're in that region, North America. That's the one area where manufacturing is doing better. It's not doing better than, in growth rates, not doing better than a year ago in China, not doing better than a year ago in India, not doing better than a year ago in Korea. By the way, China, India, and Korea right now are considered the 3 most competitive manufacturing areas in the world. By the way, who considers that? CEOs of manufacturing people who have to compete with these people. Now, I question the India part. China is obvious, and I think Korea is becoming very obvious too. That they are the dominant areas. If you're competing, you're probably bouncing against one of those providers. Okay? One or more of those providers. That's probably where your problem is. With Brazil in a couple of areas, you're going to have some problems too. Brazil is considered the 5th in competitiveness in the world. The United States is 4th. We still hold a position. We used to be 1st. We're considered the 4th most competitive. By the way, what is hurting competitiveness in the United States? The fact that off the production line, our costs are 18% more than our competitors. Okay? That's for compliance. That's for difficulties in supporting intellectual properties, whatever the issues are, in terms of it is the medical programs that employers are financing for their employees, all of these issues, the retirees, the legacy benefits that are being paid to people who are no longer producing anything. Okay? 18% more. So we start with an 18% deficit. It's also the taxes. Japan, by the way, has cut its corporate tax rate, which now makes the United States have the highest corporate tax rate in the world. Which for GE doesn't matter. For a local business, that's what they pay. Okay? So, it's really amazing. People, what does this mean? Well, who creates the jobs? It's the local businesses. That's where the job growth comes from. Those big guys, they acquire. That's how they grow. They're not the innovators, mostly. Apple is an exception, obviously. But they aren't mostly the innovators. The innovators are at the smaller levels, and then they get acquired. And that's how the big guys grow. Okay? So therefore, the foundations have to be at the smaller areas. Now, in manufacturing, you're not fundamentally going to talk about 1 or 2 people's shops. And there's a certain size that you probably have to get to make manufacturing efficient and operational and things of that nature. So it is a small corporate activity. Yes, it's not a big corporate activity. It's the $50 to $100 million sales group is where a lot of the growth is developing. And even in automobiles, while we are opening up some assembly lines, and obviously they're billion-dollar things, okay, the big growth is in the parts. And some of those are pretty small shops. Okay, so anyway, we do have a problem with our competitiveness, and our tax codes are a disincentive. We are over our productivity gains are remarkable. Even in the last year, although U.S. productivity gains have not been great. Heck, you pass all these regulations, you find that the banking industry has to hire a lot of people for compliance. So, that's not providing service, but it requires people. That doesn't help productivity. Manufacturing is actually, our productivity gains continue to be 5% a year, which are quite strong. and very competitive, especially if the dollar falls in value. Now, of course, with the euro problem, the dollar had been rising in value. Remember, a year ago, on a Federal Reserve index, our dollar was at 95.5. Today, it's at 100.5. So we actually increased by over 5% in the value of our dollar against the world. Now, not against Canada, which, by the way, we shouldn't be building any auto assembly plants in Canada anymore. They're no longer competitive, not with their exchange rates. But anyway, Canadians know that yet. Shut down existing facilities, but you don't open anymore. Canada is going to lose. We're already getting the Japanese, and now we're going to bring some of those Canadian activities back into the United States. Autos and aerospace are clearly our dominant areas going on. Okay. Will manufacturing continue? Like Obama said, we're going to create 1 million more manufacturing jobs in the next 4 years. And you kind of sit there and say, okay, I guess if you're going to do that, number one, let's lower that 18%. That's where you have to start working. And it looks like tax codes is probably the first part of that. If you're going to really start to create that kind of jobs domestically. Now, American industry is creating a lot of jobs around the world. But to create them domestically, and that's what he's talking about, you're going to have to make the environment domestically a little bit more compatible. Maybe we can improve our competitiveness against China. We certainly haven't improved our competitiveness against Japan. We're probably struggling against Brazil, although Brazil, by the way, its manufacturing is now off from a year ago. It's actually negative year over year. Brazil is very close to recession at the present time. Well, I'll just have to watch to see what's going on there. I was wondering, they actually ran for 4 years without any significant change, and they have a really bloated government sector. I mean, Brazil has a very large military. I don't know who they're fighting aside from the people in the slums. They have a very large military. Why? Are they about to go to war with Argentina? Maybe they are. Huh? I mean, you know, every once in a while, Chile and Peru throw people at each other. And by the way, we never hear it until you get to Chile or Peru. Then they're all talking about it. But otherwise, you don't hear about it. So there is some animosity. But they got, very bloated government sector. And they haven't really changed that. And they do have pension program problems, again, in the government sector. And they haven't changed that. You can work in Brazil government for 10 years and then get a full pension. I mean, even in Chicago, you don't get that. So, anyway, it's just interesting. All right. Next year, I do think trade's going to turn around. Again, we have to solve some of our problems. If we go into recession the first half of the year, there's no question that world growth is going to slow. And we're already talking 3%. We're already talking on the brink of world recession. So we could push us down into a world recession, something in world growth rates. And under manufacturing will fall. We just can't tolerate that kind of an environment. So we have some of these problems. Notice I didn't say we will, I said we have to. Will and have to are two different things. And I understand when people aren't making decisions. But anyway, that's what's going on at the present time. Now I'm going to give you some time for questions. Anybody want to ask me anything? Go ahead. Oh, I got a lot. Yeah. All right. We're going to get some interaction here. Go ahead. That doesn't mean I know the answers, but go ahehead.
I heard you once before talk about areas where the United States in the future we talk about anything other than energy. So I'm asking, what would you say is the future of the areas we're going to have a tough time competing in the U.S. and what areas would you say have an advantage versus?
Yeah, well, energy is interesting because, all right, obviously we don't have the cheapest energy. The cheapest energy is in the Middle East. Mexico, by the way, does have relatively cheap energy. And Mexico is coming back. Slowly, but it's coming back. If they could solve their corruption problem, I don't know if that's possible, but if they could do that, then Mexico would be a very formidable competitor. and probably the number 2 competitor to us, as well, if you exclude Canada. Mexico and Brazil would be our big competitors in this part of the world. So they have cheap energy, and they're cheap, and obviously the cheapest in the Middle East. But if you take a look at our energy equation, if you look at a rank from 1 to 10, where 1 is Saudi Arabia, stamp your foot and you'll get some oil. 10, by the way, is China. China and Japan, by the way, also. These people pay the most. They don't have the stuff. China has coal, but look what coal is doing. And they don't, I'll guarantee you, they won't pay the money to make clean coal. So, coal is a problem. They don't have oil. They're importing about 5.5 million barrels a year now in oil. All right, we import about 19. But our imports are going down. Theirs are rising by almost 1 million barrels a year. Okay? They're taking most of the increase in oil activity in the world. That's high-cost stuff. We got natural gas. They got some natural gas, but they don't develop it very well. China and Japan, energy, 10. Saudi Arabia, 1. Mexico, 2. We're about 3. Europe is in the 6s. We, against everybody we compete, with the exception of Mexico and Brazil. Brazil is a self-sufficient country, probably the only self-sufficient country in the world, meaning that if the world shut down and Brazil could meet all of its current needs and maintain its current living standards with its own resources and its own capabilities. No other country can say that. Now, that doesn't mean they're doing it. It doesn't make economic sense to do it. But they have works because it comes from sugar cane. When you use ethanol from the whole plant, you get more ethanol out of it for any input you put into developing that plant. We get ethanol out of the corn. Throw away the rest of the plant. Guess what that means? When you do the ethanol ratio, it's about 105 to 1, or 105 to 100. Meaning that for $1 input in energy, starting from the seed, plowing the fields, whatever you need to do, putting the fertilizer on, getting the things out, processing the stuff, putting it in the car, and using it, okay? You've used 105% of the energy to save 100%. Okay? Doesn't work. Why do we have a strong ethanol? We know it doesn't work. How do we know it doesn't work? We have a 55 cent per gallon subsidy and a 51 cent per gallon tariff. 55 cent per gallon subsidy in the production of ethanol in the United States and a 51 cent tariff so we don't get the cheaper ethanol coming out of Brazil. Okay, who has the best and most efficient ethanol program in the world? So anyway, Brazil is going to be competitive. Mexico is going to be competitive. There's always rumors that the Middle East will do something other than produce oil, but we're waiting to see what that is. Obviously, Dubai has financial services and things like that, but and that's obvious too because oil generates a lot of finance. But you know, generally, we are very competitive on energy. We actually are very good. We pay more wages, but we have more skills. If you know, we have some problems finding some of those skills, and by the way, we're again foolish program. And I don't know what you think about immigration, but when you have talented people that want to be in the United States, we should find a way to make sure they can be here. Okay? I mean, you know, why do we lump everybody? Immigration, you know, we're going to stop it. And therefore, let's worry, because, you know, 1/3 of the illegal immigrants are people who came here legally and then stayed here illegally. And one of the venues, obviously, tourist visas and student visas are the way to do that. Okay? So now we're putting the pressure on student visas. Is this smart? Well, you know, let's get away from the fraud. Sure, there's some fraudulent people. They say they're students and drop out in 6 months and you don't know where they are. That happens. Let's deal with that problem. But what if talented people? Let's find a solution for them. When was the United States turning away people who wanted to be here and contribute to our country? We're doing it now. Our current immigration policies are doing exactly that. We need to do something to address that program. And by the way, if we don't, in 10 years, now I'm not, Japan, they have a cultural problem that I don't think they're going to be a serious risk to us. But China will. China universities are getting better every year. Right now, one of our great positive contributions is that we have the best university system in the world. People still come to, I mean, this is one of the problems. Hey, we're shedding them away. People come to our universities. I didn't necessarily say our colleges, but the upper level classes they come to. They want to be here. That includes Georgia Tech. I'm not sure it includes Georgia State, but I won't say it. Okay. They want to come. And, you know, I was in Japan at the time that the second Japanese ever who was not political or artistic received a Nobel Prize. Second ever, by the way. Wow, if we only have 2 in a year, we think something's wrong in the United States. Okay? They don't innovate. And it was really amazing because I was in Kyoto at the time and the papers came out, and I can't read them, but someone else read them. Oh, isn't this wonderful? And then the next day, he kind of mentioned, he says, the reason why I was able to do this is that I left Japan 25 years ago, and I'm in a lab at MIT. And then the papers stopped saying anything about him. But, yeah, there are some cultural things that, for some reason, the Japanese are very good at engineering and very bad at creation. Engineering innovation they're good at, but actual they're not good at. Thinking outside the box, that's not Japanese. Okay? China, though, it's different. They could be world-class universities. I would rather have the best Chinese here than have them competing against me. Okay? We need to have an immigration policy that handles that. We did have an immigration. We are now working against. It's a problem. So, issues and get the emotional part of people who come over here to get dialysis and stuff. And people do. There, if you want to find it, yes, you can announce it. But there's also other things, and we got to figure out how to deal with it. Okay? And we're not doing it at the present time. So, America, as I say, our productivity is quite good. Now, there are different styles. You are now finding, like the Koreans, where their design, they don't design products, you know, remember the old General Motors thing. Well, we'll design something because we think it's needed. At designing to taste, but bringing in the production processes. And we, in the past, have been, look, we'll do the design we think is interesting. We'll then figure out how to produce it, and then we'll have our marketing guys sell it. And that doesn't work anymore. But we're getting better at that too. Okay? But there are people in the rest of the world that are competing with us. We're competitive. We're going to have employment growth in manufacturing this year, even with the decline. We're probably going to have manufacturing growth this year. And by the way, employment growth. Remember, I said productivity is growing 5%. So if you get employment growth, what are we saying? We're saying 6-7% output growth. That's significant. Big numbers. In fact, almost getting up to what China is really doing when they reported industrial production up 9%. Yeah?
Where do you see the euro going in the next year?
Where's the euro going in the next year? Well, muddling through says they're going to be between 125 and 130.
And that's my forecast that we're going to muddle through. So say 125 and 130. Solving the problem, euro will get more strength. Slow, but it will get more strength. Probably in the 135 range. Obviously, euro collapses, and you're talking, what's the next solution? And by the way, when I say the euro collapses, they're not going to let the euro contracts go into other currencies. So that they're not going to have that collapse. What they're going to have when the euro collapses is that basically they'll muddle on the euro until the euro loses enough value so that the Italians certainly, and maybe even the Spaniards, become competitive at the rest of the world with those euro rates. Now, our estimate right now is for Italy to be competitive in the rest of the world, you need a euro of about 115. Italy is pretty close, which is one of the reasons why Monti is saying, I may not join this program. What Monti is doing is collecting taxes. He found enormous tax evasion in Italy, and if he collects enough taxes, he may not have to borrow that much. Although obviously there's a lot of debt outstanding.
So you can take whatever side on this. I'm doing the 125, 130 that periodically going to say, hey, we got a solution, and this thing, it's not quite there yet, and we got to do a little bit more, and then you slowly see people ceding some of their sovereignty to the better good, which is what's slowly going on. And that will eventually solve it too, so you'll be coming to the solution two ways. More integration, moving towards solution, more devaluation, moving towards solution. Okay? And the quicker they do the integration, the less the devaluation. And if they fully integrate, it'd be a strong currency. Because it's a very deep currency. It could be a very deep currency. Okay? But I'd say right now, if I'm competing against Europe, I'm saying 125, 130, which means close to what it is right now. Yeah, go ahead. Follow
Follow-up question, completely different. Obviously, you mentioned election in about 60 days.
Yeah.
The current admission stays, where is our business climate going versus the change?
Well, this administration is not very pro-business. I mean, that's obvious. Even if he believes it, and I do believe he does, he never should have said that you didn't build your company. That's a stupid statement. You just don't do that. And if you had a feel for business, you know you shouldn't say that. He would know that, and he didn't. He obviously has no feel for that. And I'm sure his counselors are telling him we're now the highest corporate tax rate in the industrialized world, and maybe it's time for us to do something there. And a couple of things. I mean, GE's not paying any taxes, so there's a couple things to do. Let's do something to make sure that GE pays a little bit over here. A little bit. They got a lot of government contracts. Why don't they at least pay a little taxes here? And let's do something else so that the small businesses can actually keep a little bit more of what they produce. And it's achievable. We do know our current tax system is inefficient. Again, that example tells it right there. That the people who create the jobs are getting clobbered by heavy burdens, both regulatory and tax burdens. And the people who are global, they're finding outs. They're finding exclusions. And as a result, we're giving away a lot for the exclusions of people who only create jobs when they buy other companies. Okay? And we're not doing much to the people who are building up and hiring new people. Not a good, efficient system. And I'll go to the individual thing too. I keep telling about, if you're a stockbroker and you take a percentage of the assets that you manage, that's a salary. If you're a hedge fund, that's a shared interest, which means that you are part of the investment. So as a result, stockbroker is paying 35% on the fee that it is taking. The hedge fund is paying 15% on the fee that it is taking. All right. Now, you sit there and you say, well, what does that do? 15 years ago, hedge funds had $100 billion. Today, hedge funds have $2.5 trillion. And I'm not sure hedge funds are that economically efficient. We can argue that point. But there's another case. Our tax codes are really screwing up things. We've got to change these tax codes. These are crazy tax codes. And by the way, I said change them. I'm not in the belief that, hey, let's keep the Bush tax codes. We've had less growth under the Bush tax codes than any other tax code that we ever created, except for the Mellon tax codes, which of course created the Great Depression, or was a contributing factor to the Great Depression. Okay? Tax codes can create problems. We have a problem-based tax code right now. I don't know why people are in love with it. That doesn't mean that, hey, we solve it by raising the marginal tax rate on the higher income people. That's stupid. But anyway, you had a question.
One more question.
Okay.
You mentioned India before and some of the problems
Yeah.
they didn't feel. What
Yeah, I backed away. India, in the longer term, is going to be a powerful player. And, you know, I didn't believe that because you look at the corruption of India, you look at the infrastructure in India, you look at the stealing of intellectual properties in India, which is quite dramatic. And, you know, all of these things get you very, very nervous about where India is going. And, you know, China doesn't steal anywhere near as much of the intellectual property. They do some, and there is some patent and other infringements, but nowhere near what India does. On these things. So all of these are significant deterrents. But there's going to be an awful lot of Indians. By 2030, India is going to be the most populous country in the world. That is going to make a difference, that demographic shift. If they can continue, they do have an educational tradition. They are now, because of the internet, they've opened up that educational capability is starting to show results in India. Little pockets, to be sure. It's not the whole country by any means. But one can make a case that in 20 years, India will be the China of 20 years from now. Okay? But obviously they got to get their corruption under control. They got to do something with the intellectual property rights. They got to do something, well, they got to do with intellectual property and then something with property rights. They got to get that socialist tinge out of their government policy making. All of those things probably are necessary before they're able to move in that direction. But, you know, you're sitting there and you say India has a lot to do yet. They're still growing 5.5% to 6%. And it's a fairly big country, so yeah, they're way behind, but they could be the China 20 years from now. And by the way, what would China be? Well, I already said the costs in China are going up. They clearly mismanaged their economy. They overstimulated, and now they overcut it back. They're having problems directing what's going on there. They have very significant inequality, not only between wealth, but also between Eastern and Western China, also between the cities and the rural areas. You know, it's a wonder that a new Sun Yat-sen hasn't come out of the rice fields, to be perfectly honest. So what about China? Would I put China in the top 20 years from now? Well, yeah, maybe. And you might say, why, yeah, maybe? Well, yeah, they do have some momentum right now. But the other part of it is what I just said about the universities. We're chasing people back to China, and China will create world-class universities if we continue to do that. India probably won't, although they do have some tradition there. So we'll watch. But I'm not sure India will do that. But China could very well do that. And if they get to that world-class basis, and they start to innovate, and you start to see Chinese on the Nobel list, wow, things could really change very dramatically there. But at the present time, I would say it's more like 20 years from now, I'd be looking at India as the big power. But they have work to do. They have to do things to get there. And I don't think they're number 2 right now in competitiveness, largely because of their property rights and their intellectual property issues. All right. Thank you very much.
On behalf of Georgia Tech, we wanted to present Dr. Ratajczak Ratajczak with a small token of our appreciation and everything. And Georgia Tech gear for him. There's a buzz, and of course there's a Georgia Tech pin in there which has a flash drive built into it, which is pretty cool. So anyhow, we really appreciate your informative and interesting talk this morning, and you coming back from your vacation to spend some time with us today. That's what I heard. I thought you were in Keyway.
Yeah, but that was at work.
Oh, come on. Keyway, work. Come on. Thank you very much.